It is not as easy to go through this process as it is with a conventional home loan. So let's see a calculation to see an example of how this could save you money. If you're looking on screen, we have our $300,000 property, and we're going to, in this scenario, say that this person is not assuming a mortgage from the current owner. They are instead going to secure a mortgage at current interest rates, which we are illustrating as 7%. If we have a $300,000 mortgage at 7%, and we're going to estimate taxes and insurance and PMI and things of that nature, we have a mortgage payment of $2,375. But now let's illustrate what it would look like to potentially assume a loan on this property. And we're going to say that the person who currently owns the property has a mortgage that's $200,000 at a 3% interest rate. So the buyer of the property would assume that home loan of $200,000 at 3% interest, and they're going to get a second mortgage on the property for $100,000 to make up the difference in the total purchase price at 7% interest. So just to recap, they have a $200,000 assumed loan at 3% and a $100,000 second mortgage at 7%. That gives them a blended rate of 4.33% on their loans in total. And now, if we look at what it looks like to have that property, $300,000 at 4.33%, it decreases their payment from $2,375 to a little under $1,900. So this person in this scenario saves over $400 a month by, instead of getting their entire loan at 7%, assuming the original loan on the property and getting a second mortgage to make up the difference for a blended rate that's lower than current market conditions. Now, there are a number of pros to the buyer and seller in this scenario beyond the obvious. Let's talk about them. If you are a home buyer, well, the obvious is, hey, I'm getting a lower mortgage rate, at least on a significant portion of what I owe on this property. And that is better in most scenarios than going out to the market and paying a significantly higher rate. You also are going to have a lower overall cost of home repayment. See, we're thinking about just the mortgage payment itself, but at lower interest rates, it's going to cost you less in the entirety of the repayment period. And you're going to be getting equity in that home faster because more of your payment each month is going towards the principal as compared to interest. It doesn't take much to explain the pros to the buyer in this scenario, but there are also pros to the seller. Remember, when you're letting someone assume your mortgage, it's not like you're getting any less money for the property. You had to pay that off if you sold the property in the first place. You still owed the mortgage. So you're still getting your equity in the property at closing, just like in any conventional home sale, except now you've made your property more appealing because you have the opportunity to offer a potential buyer a lower interest rate than if they went to a property where they could not assume the home loan. This means that feather in your cap that you may be able to list that property at a higher price because there's now something you're offering that the competing houses cannot. So hopefully you see the benefits from both perspectives. And while this is a potential opportunity for people out there, and it may seem like, the salve for all that ails you, there are some complexities to the assumable mortgage. And there's a reason that you may not have heard about it before you listen to this episode.